So, what's going on with the US dollar? Seriously, it's one of the biggest questions in global finance, and right now, the signals we're getting are pointing in completely different directions. In this explainer, we're going to unpack this whole dilemma and figure out what it all means for 2026.
So let's just dive right into the big one, right? Is the dollar's long-held dominance as the world's go-to currency actually at risk? It's a massive question, and by the end of this, you're going to see the powerful competing forces that are pulling the answer in two totally different directions.
Okay, to even begin to get our heads around this puzzle, we got to start with what the experts are actually predicting. All the major financial institutions have been crunching the numbers, and they see a pretty clear, though gentle, trend starting to emerge for 2026.
Let's start by zooming way out, to the long-term view. See, analysis from RBC Capital Markets suggests the dollar moves in these massive, long cycles. The last two each lasted around 16 to 17 years. So the big takeaway here isn't about some temporary dip. It's that we might be in the very early stages of a third major weakening cycle.
So yeah, the consensus view is for the dollar to get weaker. But you gotta notice the key word here, mild. Nobody is out there predicting a crash, just a gradual decline. But as we're about to see, the path to that weaker dollar is absolutely full of contradictions. RBC kind of breaks this whole forecast down into 5 key themes. First, you've got that mild dollar depreciation we just talked about. But look at the other factors at play, a positive outlook for Asian currencies, and a big focus on something called the carry trade, which is really just investors profiting from different interest rates between countries. Then you sprinkle in inflation and political uncertainty, and, well, you get the big picture.
And this chart right here really puts it into perspective. It shows the gap between what the market expects and what RBC is actually forecasting. The forwards market, that's basically what traders are betting on, is already pricing in about a 1.3% weakness. But RBC's analysts, they're even more bearish, predicting something like a 3 to 4% decline. So the experts think the dollar is going to fall even more than the market currently thinks.
But this is where things get really complicated, and honestly, a whole lot more interesting. Because while the forecast points one way, what investors are actually doing with their money is telling a completely different story. This is what we're calling the Great Dollar Paradox. So on one side of the coin, you have this incredible optimism for American companies. I mean, RBC's strategists are forecasting the S&P 500 to hit 7750. That's a huge bull case. But then, at the exact same time, Deutsche Bank is noting that foreigners are getting rid of their dollar risk at an unprecedented rate. So how can both be true? How can investors be buying America but selling its currency?
This number right here it's just staggering. In just the last 3 months, a full 80% of new money flowing into U.S. stock funds from overseas came with insurance against the dollar falling. Think about that. Investors are pouring money into U.S. assets but are literally paying extra to protect themselves from the very currency those assets are priced in.
And this quote from JP Morgan's Meera Chandan, it just absolutely nails it. The feeling out there isn't sell America, it's hedge the dollar. And this is the crucial point. Investors want in on the growth of U.S. tech and AI for sure, but they don't want the risk that they see coming with holding the U.S. dollar.
Okay, so she used that key word, hedge. To really get what's happening here, we need to quickly break down what that actually means and how it works. It's the key to the whole paradox.
You know, the easiest way to think about hedging is, well, it's basically insurance, right? If you own a house, you buy insurance against the fire. Well, if you're in Europe and you own a U.S. stock, you can buy insurance against the dollar weakening because that would totally eat into your returns when you convert them back to euros.
So how do you buy this financial insurance? The main tool they use is something called a forward contract. It might sound super technical, but the idea itself is actually pretty simple. You just agreed today on an exchange rate for a transaction that's going to happen in the future. You literally lock it in no matter what the market does between now and then.
And look, the process is dead simple. It's just 3 steps. First, you figure out how much you need and when. Then, you get a quote and lock in today's rate. And finally, when that date arrives, you make the exchange at the rate you already guaranteed. It completely takes any future surprises off the table.
So, okay, what's the catch? What are the trade-offs here? Well, the big pro is certainty. You are completely protected if the exchange rate moves against you. But the con? You're locked in. If the rate suddenly moves in your favor, you miss out on those extra gains. It's that classic choice. Do you want to protect your downside or do you want to keep your potential upside? And right now, it seems like a lot of investors are choosing protection.
All right, Let's pull all these threads together now. We've got a forecast for a weaker dollar, but at the same time, we've got this massive investment flooding into U.S. assets. And we know investors are using this hedging tool to separate the two. So, what does it all mean?
Which brings us back to that one simple question with a ridiculously complicated answer. Is the dollar strong or is it weak? And the truth is, it's both. It's being pulled hard in two opposite directions at the very same time.
And this is really the core takeaway. It's a giant tug of war for the U.S. dollar. On one side, you've got forces pulling capital in, things like strong U.S. companies and economic growth, but on the other side, you've got these forces pushing investors to hedge, things like political uncertainty, that long-term weakening cycle we talked about, and shrinking interest rate advantages.
So, let's circle all the way back to that huge question we asked at the beginning. Is the dollar's role as the world's reserve currency in danger? This quote really gets to the heart of it. While there's some very real concerns out there, the simple truth is, right now there just aren't any clear alternatives. The euro, the yuan, they're just not ready to take over that role.
So at the end of the day, the dollar's future, it isn't a simple story of strong or weak. It's a story of tension. A tension between America's incredibly dynamic companies and its polarizing politics, between its role as a safe haven and the growing questions about its long-term stability. And how this tug-of-war finally gets resolved? Well, that's not just going to impact investors, it's going to shape the entire global economy for years to come.